Nonku, let's get straight into it, because I've been speaking to market watchers about these numbers. No one was expecting anything stellar from the company. One thing you've been commended for is actually keeping the markets abreast of issues that have plagued the company. More so, they were awaiting to see the extent of the ugliness of the numbers here. I mean, it's come through with a headline loss of 13 cents, profit from operations down 86%. Certainly a tough year you've been through.
Very. And again, very much a two sort of profile year. The first part, reasonably okay. We had a good level of buoyancy in the market up until June. July came. First, there was a strike in South Africa in the steel industry that took us out 2-3 weeks when our customers were off. But the big issue was at macro level. Once the Eurozone debt crisis started to play out, everybody ran for cover. South Africa GDP in Q2, Q3 grew 1.1% and 2.5% respectively. And that's just not enough to sustain the steel business. We need in excess of 3% market, GDP growth in order for us to start seeing investment coming through. So very bad at macro level globally, very poor in South Africa as well. But I suppose the story would not be complete if we didn't also talk about operational problems at ArcelorMittal South Africa itself. We had one mill out for 4 months in the second half, and that is our long products mill. Now, the little bit of market bounce that we had in the second half was actually in long products. So we were out of the one part of the market that had some level of support. So I think by and large that explains it on the demand side. But the big issue, again, was on the cost side. Costs just continued to rise and escalate in a similar trend that we saw in 2010.
What's your assessment of that supply-demand dynamic that's out there? Because now that there's unutilized capacity worldwide, that would be an impediment to jacking up prices moving forward to offset some of those escalating prices that you're experiencing on the input front.
Well, I agree that capacity in the steel industry globally is a concern, and ArcelorMittal Group has been a leader in trying to control that and take capacity out of the system, and other companies have followed. But we have to be very cognizant of the fact that it is China that ultimately drives this. China today account for over 45% of global production and 44% of global consumption. So they really are the driver of raw material cost escalations. And as long as they're off-taking from particularly iron ore and hard coking coal, we're not going to see that moderate too much. We have to say, though, that in the first part of the year, in this very early part in January, we've seen hard coking coal prices begin to soften, or at least stabilize. So versus $262 per ton on average last year, at the moment trading around $220 a ton. So maybe that is also coming off the boil to some degree. Iron ore at this moment is about $145, $150 a ton. Iron ore averaged $170 last year. So there may be some reason to be optimistic at the early stages, at least, that those prices may be stabilizing.
You're optimistic even with, operations, for example, at your Newcastle plant resuming full output and adding to the supply side of things. I mean, looking at that, is it not possibly time to, or a need out there to be cutting back on production?
Well, now that's a bit different. If you then take the lens to the domestic market, we, as South African steel producers, on aggregate, produce 8 million tons of steel, and 5 million are consumed in South Africa, and the 3 million is exported. So then Newcastle is a very big part of that 5 million that's consumed domestically. And in fact, what you would see is, if you look at import numbers, that shot up. By the end of the year, South Africans had imported 900,000 tons of steel, or approximately 17-18% of consumption, which is way out of the norm. The norm is about 12%. So there is no question that domestically we are in an excess capacity situation on the long product side. So there is space for Newcastle, very, very definitely. Remember, we've always been around 57% market share in that market segment. It came down below 50 because of the operational problems. So we don't anticipate any real change in market dynamics by bringing Newcastle back. But if you're talking about the sub-Saharan African continent, specifically now, that's growing. It is the one region of the world that's growing. If you look at the GDP forecast for 2012, that's 5.6%, 5.8%, that order of magnitude, compared to 5.2% last year. So it is the one part of the globe that's growing. We are the natural suppliers in that market, and we're not going to give away that market space.
So no fear of the competitive landscape out there right now. I mean, how are you assessing your competitive muscle at this stage of the game?
Well, ArcelorMittal South Africa has always been in the lowest quartile amongst global producers of steel. And it is a position that we lost as a result of losing the supply agreement with Kumba, but we're still very well positioned vis-a-vis our competitors, and we compete very strongly in the key selected markets in which we trade. We have a fairly solid presence in East Africa, a good presence in Southern Africa, particularly neighboring countries to South Africa. So those are all markets which we think of as in our backyard, and we continue to compete very strongly in those.
So let's put the spotlight on this disagreement that you continue to have with Kumba. I mean, the statement today saying you're fully confident that the Kumba supply deal arbitration process will rule in Arcelor's favour. What's underlining that confidence?
Well, we've always been confident as a result of really principally the mineral rights issue. The mineral rights issue was what the North Gauteng High Court ruled on last year, December. And our interpretation of the conversion process and of the ownership of that mine essentially was upheld by that court. If you go back to the SENS announcement that Kumba issued when they cancelled our contract, they said they're doing so because they believe that in losing our mineral rights, we lost any entitlement to the supply agreement. Well, we didn't lose our mineral rights because they had been given to Kumba, and this the court has now actually confirmed. Clearly, this is now going to go on appeal, and as you know, last Friday, the government and the DMR and ICT both sought leave to appeal, and that will play out as it plays out. But if we are again upheld on appeal, we think that our arbitration case is rather strong.
If you're going to have problems with the supply contract from Kumba moving forward, I mean, what would it imply in rands and cents? Because it would have huge implications, as you alluded to earlier, on your cost structures, and it would impact margins in a big way.
Oh, it would. We haven't actually quite come down to calculating those, because at this point we're not really contemplating seriously that we would be defeated in that exercise. But you have to remember that at the moment we have an interim agreement with Kumba. We were paying on average $65 per ton for steel, and already we've absorbed an almost 100% inflation or cost inflation vis-a-vis where we were with the cost plus 3%, where we're paying around $35 per ton for iron ore. So we're halfway there, so to speak, and it wouldn't all come in one gulp.
Let's look at the outlook ahead, because your earnings for the first quarter are expected to improve significantly. What do you mean by significantly, and what's the basis for that? What are you relying on to support growth from here on out?
Well, by significantly we mean something in the double digits. It's something that the JSE does provide in terms of guidance. If you think it's going to be around 15 to 20%, it's significant. Above 25, it's substantial. So it's something around 20% or sub 20% growth on earnings. And the reason for the confidence is that, remember, we now are over month one of a 3-month cycle. We're only giving you a quarter outlook. And so we have seen what the order book looks like. It looks strong. It looks strong because of stock replenishment, really. We're making no kind of assessment of growth in underlying demand. So order book is strong. We can more or less model the steel prices because we know where they are. If they're going to go down at all, it would be for a short time in this period. And our operations at the moment are stable. Newcastle is back fully on production. So all of the factors you would look at in putting together an outlook are positive for the company for first quarter.
For the first quarter at least. Let's leave it there. Thanks so much for joining us in studio this afternoon.